Welcome to Delphos Insights.
It's great to be here.
So today we're looking ahead, specifically to the year 2026. And, if you've been following the macroeconomic headlines, especially out of the US or Western Europe, the mood feels a bit like a hangover.
There's a lot of talk about slowing momentum.
Exactly. Slowing momentum. Interest rates are doing their damage, and there's this general sense of, tapping the brakes, but there's this massive counter-narrative building that I think a lot of investors might be missing.
I mean, it's really a tale of two global economies, isn't it?
That's the perfect way to put it. While the traditional powerhouses are decelerating, emerging markets are positioning themselves as the primary engine for global growth. And this doesn't feel like just a blip. It looks like a real structural shift.
It does.
We're basing today's deep dive on the Emerging Markets Investment Outlook 2026, which is a really comprehensive report from Bart Turtleboom, the chairman and CEO of Delphos, and senior director Kanchan Desai.
And the mission for our discussion today is quite specific. We're not just, analyzing data for the sake of it. We really want to understand why 2026 represents such a critical window for development finance institutions, DFIs, and for impact investors to deploy capital.
Right.
The argument that Bart and Kanchan are making is that this is the moment where financial returns and developmental impact are really aligning almost perfectly.
So we have a lot to get through. We're going to look at that growth divergence, the rise of the digital and green economies, and then some really grounded, real-world success stories. I'm thinking of places like Sierra Leone and Chile.
Right.
Let's start with that big picture, the great divergence. When we look at the actual data for 2026, what does the scoreboard look like?
Well, the divergence it's pretty distinct and frankly hard to ignore. If you look at the projections for 2026, emerging markets or EMs are projected to grow at a rate of about 4%.
4%. Now, how does that stack up against the advanced economies?
That's where it gets interesting. Advanced economies are projected to grow at just 1.5%.
So that's a spread of 250 basis points.
It's a massive gap. And what this tells us is that EMs are going to be driving a very, very significant share of global GDP growth. We're kind of moving past the era where these markets just drafted behind the West.
They're building their own momentum.
They are. So if you're allocating capital based on where the growth is, you just can't ignore that 4% figure against the 1.5 in the developed world.
I want to challenge a common assumption here because I think a lot of people, even savvy investors, they still kind of hold on to this idea that EM growth is strictly because they're selling cheap goods to the West.
The old export model.
Right. The narrative is that if the US consumer stops buying, EM growth just collapses. Is this 2026 growth just about exports?
That is probably the most common misconception, and clarifying it is, well, it's central to understanding the opportunity here. This growth is powered by strong domestic demand. The data in the report highlights that about 3/4 of real GDP growth in emerging markets is being driven by factors inside those countries.
So we're talking about their own middle class, their own consumers.
Precisely. It's rising wages, it's expanding digital ecosystems, it's massive infrastructure development, it's the consumer in Jakarta or Lagos buying services, using data, purchasing goods.
So it's not just about the shipping containers leaving a port.
It's a self-sustaining fire within these economies.
That brings us to valuation. I mean, usually in finance, if you want high growth, you have to pay a high price for it. Is that the case here? Are these markets expensive?
And that's the anomaly. The inverse is actually true right now. Emerging market equities are trading at really significant discounts. If we use the PEG ratio, the price to earnings to growth ratio, it gives us the clearest picture.
Right, and for our listeners, a PEG ratio of 1 is generally seen as fair value.
Exactly. And emerging markets are trading at about 1.1 times.
Okay, 1.1. And what about the US?
The US market, by comparison, is trading at around 2.0 times.
That is a stark difference. You're basically paying double the price for a unit of growth in the US.
You are. And you also have to look at the quality of that growth.
Right.
For 2026, earnings growth in EMs is projected at 14%.
14.
Compare that to the S&P 500, which is hovering around 6%.
Yeah.
So you have stronger fundamental earnings growth available at a much cheaper valuation. It's a rare alignment.
Okay, let's quickly touch on the monetary environment. Inflation has been the big story for years now. Does that cloud the picture for 2026?
I think the storm clouds are finally breaking. Inflation in these regions is easing pretty significantly. The outlook sees global headline inflation falling from 4.2% in 2025 down to 3.5% in 2026.
And that's huge because it gives their central banks room to maneuver.
Exactly. It gives them breathing room to cut rates, which reduces the cost of capital for local businesses. It makes funding expansion cheaper.
And what about the US dollar?
We're seeing a softening US dollar. And a weaker dollar is generally very, very good for emerging markets. It supports currency stability. It makes it cheaper for them to import things like energy and to service their dollar-denominated debts.
So the headwinds from the last couple of years are actually turning into tailwinds.
That's a great way to put it.
Okay, so the macro picture is solid. We've got domestic growth, attractive valuations, cooling inflation. I want to shift now to what is actually growing. It's not just about manufacturing widgets anymore. The report really highlights innovation in infrastructure and the digital economy.
That's where the story gets really exciting. We are seeing a transition to these high-value themes. And it's not just about building roads and bridges, though that is happening. It's about digital inclusion and the financial infrastructure that comes with it.
And when we say digital inclusion, are we just talking about more people getting smartphones?
It starts there, but it goes much, much deeper. It's about financial participation. The report notes that mobile money accounts in developing economies are rising by 10% annually.
10% a year.
And we've reached a point where 40% of adults in these economies are saving through formal financial institutions.
That is a massive shift.
It's transformative. It means millions of people are entering the formal economy. They're not, keeping cash under a mattress. They're getting access to credit, building credit histories, transacting securely. That creates a bedrock for consumption that just didn't exist a decade ago.
And that must open the door for fintech companies to really scale.
Absolutely. Now, this conversation inevitably leads to artificial intelligence. Is AI playing a role here, or is that still mostly a story for Silicon Valley?
Yeah, is it a Western tech trend?
It's absolutely a global story. In fact, I'd argue you can't have the AI revolution without emerging markets. We're seeing what the report calls an AI supercycle, driving capital expenditure across these regions.
How does that actually manifest on the ground?
Well, first, just look at the supply chain. Countries like South Korea and Taiwan are just dominant in manufacturing the high-end chips and hardware you need to run these models. But beyond that, we are seeing the rise of what you might call AI enablers.
What does an AI enabler look like in, say, an East African or Southeast Asian context?
It looks like practical application. So AI is being used in agriculture to analyze soil data and improve crop yields for smallholder farmers. It's being used in health services for remote diagnostics where doctors are scarce. It's not just chatbots.
It's agricultural yield optimization.
Exactly. It's technology leapfrogging in action, using the most advanced tools to solve fundamental human problems.
The other huge theme in the report is sustainability, the green theme.
Yes. The energy transition is a massive driver of capital. We're seeing a huge surge in transition finance. To give you a concrete data point from the report, India is adding over 15 gigawatts of renewable capacity annually.
15 gigawatts a year, that's an incredible pace.
It is, and it requires some innovative financing. We're seeing the rise of things like blue bonds, which are designed specifically to fund marine conservation. But the most important mechanism is probably blended finance.
Okay, let's pause on that term. It comes up a lot. How does blended finance actually work in this context?
So it's basically the art of combining public and private capital to get projects off the ground. Let's say you have a renewable energy project in a market that private investors see as a bit risky.
Sure.
A DFI or a public entity might step in to take the first loss position or may provide a guarantee. This de-risks the whole investment structure.
So the public money acts as a kind of shield for the private capital.
Exactly. It mitigates the risk just enough so that private institutional investors, your pension funds, insurance companies, they feel comfortable coming in with the bulk of the capital. It's about catalyzing markets.
Let's zoom in on the map then. You said we can't treat emerging markets as this one single thing.
That is a crucial distinction. The report really emphasizes looking beyond the broad indices to specific country fundamentals.
Okay, let's start with Asia. You mentioned India's renewable push. What's the broader outlook there?
South Asia is actually the fastest growing region globally. They're projected to hit 6.2% growth by 2027.
Wow.
India is offering abundant structural opportunities. Even with a potential slowdown in 2025, the long-term trajectory is incredibly robust. And Southeast Asia is also vital. particularly around energy integration and connecting their power grids.
Moving over to Africa, we hear about the potential, but performance has been mixed in the past. Is 2026 different?
Sub-Saharan Africa is definitely in a recovery phase. Growth is strengthening to 3.7% in 2025 and should rise to 4.3% by 2027. But you have to be specific. If you look at East Africa, for instance,
Yes.
they are leading the charge. Projected growth of 5.9%.
Nearly 6%. That puts them right up there with the fastest growing Asian economies.
It does. They're capitalizing on improved stability and heavy investment in infrastructure. It's a region that's really differentiating itself.
What about Latin America?
Latin America presents a different opportunity set. A lot of it is centered on nearshoring, so bringing supply chains closer to the U.S. market, and of course, renewable energy. The region is so rich in critical mineral reserves.
The lithium and copper you need for batteries?
Exactly. The global energy transition doesn't happen without Latin America's resources. Brazil is a major player, though political changes there always require careful watching.
And what about Eastern Europe?
Eastern Europe is interesting, especially Poland. They are expecting really strong growth, but it's driven largely by EU funds and improving fiscal conditions. It's more of a convergence play with the broader European engine.
This geographic tour really highlights why you need that boots-on-the-ground knowledge. You can't just buy a generic EM fund and hope for the best.
The drivers are completely different, and so are the risks.
So let's ground this in reality. I want to talk about the how. The report has some great case studies from Delphos. Can we walk through a few?
Certainly. These really demonstrate that success comes from combining that local insight with global capital. Let's start with the ASEAN region in Southeast Asia. The big challenge there was energy security.
Okay, and what was the solution?
Delphos secured a $2 million grant from the US TDA, that's the US Trade and Development Agency. This funding was for feasibility studies for two major interconnectors, which allow countries to exchange clean energy across borders.
So $2 million creates the blueprint for the entire grid.
It unlocks the whole project. It lets you generate power in one place and use it in another. Strengthening the whole region's energy security is a very high leverage use of capital.
Let's talk about Sierra Leone. Infrastructure there has been a huge hurdle.
Specifically, airport capacity. It was severely limiting both tourism and trade. If you can't get people and goods in and out efficiently, the whole economy just suffers.
So what happened there?
Delphos structured a $150 million loan via the DFC, the U.S. International Development Finance Corporation.
That's a significant amount of money.
It allowed for the full expansion of the airport, ensuring it met international standards. A project like that doesn't just build a runway, it creates connectivity for the whole country. It really opens the country to the world.
I have one more example here that I like because it focuses on the smaller players, SMEs in Chile.
Yes, the Maxa case study. Small and medium enterprises often struggle to get financing from big banks. They're caught in that middle ground.
Too big for microfinance, too small for corporate banking.
Exactly. And in Chile, this was a major bottleneck.
Yeah.
Delphos secured $10.6 million for a company called Maxa, which specializes in financing for these small businesses. That capital goes directly to entrepreneurs. It creates jobs immediately.
So if you connect these stories, energy in Asia, and infrastructure in Sierra Leone, SMEs in Chile, the common thread is partnership.
That's it. It's about finding the right capital structure to solve a specific local problem.
Okay, we have to be realistic. We've painted a very positive picture, but investing in emerging markets is never without risk. What are the headwinds we need to be aware of?
You have to acknowledge the risks to manage them. The biggest one is probably debt. Global debt is set to surpass $100 trillion, and there's a concentration of maturities coming due between 2025 and 2027.
That's a huge wall of debt that needs refinancing.
It is. And that creates refinancing risks, especially if rates stay higher for longer. And then, of course, there's geopolitics, trade tensions, tariffs. Those can always disrupt growth.
So if I'm an investor or a DFI, how do I manage this? What are the tools?
There are established strategies. Things like currency hedging are essential. Partnering with local governments, using political risk insurance.
Right.
These provide a safety net. And importantly, the report highlights ESG standards not just as a compliance thing, but as a risk management tool.
Right. Good governance equals less risk.
It really does. Bart Turtlebone puts it very well in the report. He says, and I'm quoting here, "The question is no longer whether to increase exposure to emerging markets, but how to do so with precision and partnership."
Precision and partnership. That really seems to be the core philosophy.
It is. Navigating these markets requires that strategic insight, a long-term development lens. You know, Delphos has a 38-plus year track record. That on-the-ground experience is what allows you to distinguish between a headline risk and a real fundamental opportunity.
So as we wrap up, let's summarize the main takeaways. 2026 looks like a breakthrough year. You have emerging markets driving global growth through domestic demand. You have these massive opportunities in digital innovation and the energy transition. And we've seen that with the right partnerships, capital can solve real problems.
The key is that the window is open. The valuations are attractive, the inflation environment is improving, and the impact potential is just enormous. It's a time for purpose-driven investment that can actually generate strong returns.
It certainly feels like a shift in the global economic engine. Before we go, I want to leave you with a question to consider for your own strategies. As we look at this shift, how can your portfolio contribute to closing the infrastructure gap while capturing the growth of the next decade? This has been Delphos Insights. Learn more at delphos.gov.